growth through acquisition. Like we were so good, we were pissing the banks off. It took about 6 to 9 months to then start finding the good stuff. My favorite way to evaluate a business is to look at the life that the owner of that business currently lives. So the bigger the business, the easier it is to be able to raise money for it. Building infrastructure for a business by yourself is pretty difficult. These things might seem very basic, but they stand in the way of people actually running a very effective business. If you're the one doing everything, you learn very quickly. A good way to work 24 hours a day is to do every job.
Brendan Lippman, thank you very much for coming in, mate.
Thank you. Thanks for having me.
Did I say correctly? Lippman?
Exactly. Yeah, Lipman. Lipman. That's
very good.
Yeah.
Mate, first of all, thank you, because I saw you online. I was like, all right, this guy knows what is he doing. So for people that never seen you before, you are currently on 12 businesses.
Right. Yeah. So we've bought 12 businesses in similar industries, and we've just rolled them into the companies that we've already got. So we've done 12 deals or 12 acquisitions. Is how I'd put it.
Yeah. So you are now a full-time, I don't know if I can call you business buyers agent or acquisition specialist.
Either's going to work. Yeah, look, either's going to work. If there's a business we like and we can afford it, then we're going to buy it. We're going to try buy it at least.
Thank you. Thank you. I like that. Yeah. So I'm going to put the name acquisition specialist.
All right.
And that's the reason I contact you, is because I really liked your course.
Okay.
By the way, it's free.
Free run. It's never going to be charged. I don't believe in like charging for something that's that basic, at least to me. You know, maybe in the future, who knows, there might be something to charge for. But at least with that, and the reason why I made the course is because there's such big information disparity between buyers and sellers. Like sellers are heavily informed about the business that they're selling.
Yeah.
And also they have brokers to help inform them of the selling process as well. And the constant feedback that I get from business brokers is that they actually wish that their buyers were far more informed too.
Yeah.
So that's why, like, you know, I don't really believe in like dishing out information that like levels the playing field. Yeah. Right? Like, I think it should actually be a fair game in the first instance.
Yeah.
When no one's about like doing a deal to rip anyone else off. Yeah. And I feel like if the buyers can be more empowered, we're going to see a lot more positive activity in the business acquisition space.
That so resonates with my industry.
Yeah.
Like, I'm a buyer's agent in property.
Cool.
And it's the same concept. And that's the reason they come to us, because there is, this misinformation and misrepresentation for a buyer's point of view. And when they get into negotiation against a trained real estate agent who's been doing full time, and they're like, what the hell? The price guide is 5 million and they sell it for 5.8. I'm confused. Doesn't make any sense.
Just send them into the lion's den by themselves.
That's
if they don't get a buyer's agent.
That's right. No, and I find it, and I'm on day number 3 in your course. I don't know if video number 3 has been very good.
Cool.
I recommend everyone to jump in and check it out.
Yeah, it'll always be free. There's no upsells, no nothing. It's there for good, and I'll improve it, I'm sure.
Right, thank you. So tell me a bit more about yourself. So you're born in New Zealand?
Yeah, well, I was actually born in South Africa.
Wow,
and then
whereabouts?
Pretoria.
Nice.
And then we moved to New Zealand. So obviously crime has only been going up in Africa.
Yeah.
And my parents made a great decision to move me and them over to New Zealand. Then I had a younger brother as well. He's still in finance. And so it's been in New Zealand, and one of our brands has grown. And we've got a business case to grow it to Australia, and that's why I'm here. So I've moved to Sydney, and now we're looking to acquire in Australia and just grow our businesses organically.
Very good. So run me through. So you said you have an older brother? Younger brother. Okay. And how did you get into, because after you became a mortgage broker, is that correct?
Right.
You were a partner, like you were.
I owned, part of the firm. I actually accidentally ended up owning part of that business. It was never an intention of mine.
Yeah.
But that's what kind of sparked the journey and, thinking about business acquisition. I left. I was working at a bank at the time, just like a very standard bank job.
Yeah.
And that, we know what we're like, 23, 24, 25-year-old guys, anyone in that range, like
Yeah.
sometimes we don't do too well with authority, right? And
Yes.
so I learned very quickly that standard employment was just not for me. So I was already broken from the start. So there was just no way that I was going to stay at the bank. And I got really interested in business just in general to try and figure out, okay, well, I can be remunerated on my efforts. I can take greater risk. I knew that I had to do something entrepreneurial if I wanted to make money and work and live a life on my own terms.
Yeah.
And so in that search, I ended up meeting a few guys from high school who started this finance company. And then over the years, I ended up with 20% of the business as ownerships changed, as people moved on.
Yeah.
For me to stay, I was given 20% of it on an earn out or like a buy now, pay later sort of a deal, a vendor finance transaction. And when I reflected on it, that was the thing that made the most material difference in my wealth building journey.
Yeah.
So when it came time to move on from the finance company and sell and look at what I was going to do next, it was a no-brainer to just focus on buying businesses because that was the thing that made the biggest difference for me.
Yeah. And now we're going to break down the numbers. That's amazing.
Yeah, right.
Thank you, man. Okay. So you own 20%, your mortgage broker.
Yeah. And we were good. Like, I have to tell you, we were really good. Like, we were so good, we were pissing the banks off.
Yeah.
Like, that's how
that's a good sign.
That's how good we were. It was like, I explain it as the poor man's version of Wolf of Wall Street. We were like working on trestle tables down by like a marina, breakout offices that smelt like, Lynx Africa, all sorts of what you'd expect, right?
It smells like.
Yeah, and we had a really good time doing it, and we everyone in that team who worked it was like, everyone's gone on to do really good stuff. So we had a really great core group of people who were doing it. So yeah, it was a really good time. We learned what we were doing, and that gave a great financial understanding for business, how a company operates. So started with like a pretty big leg up in that instance.
Yeah.
Yeah.
And then were you lending for businesses, properties, cars, or what?
Mainly residential real estate.
Residential.
Yeah, so a lot of what your clients would be doing. So I've like broken down financial positions of real estate portfolios, and I did that for a good maybe 3, almost 4 years. Okay. And we were doing big numbers, maybe about 100 million 1 year. Was what we wrote in lending for myself and my team, and one of my business partners did about the same.
Yeah.
So
very good.
Yeah.
Okay, and you stayed there for how long?
It's about just under 4 years.
4 years.
So about 2015 to 2019, right before COVID.
And after that, what did you? So you choose to. What was the day that you clicked? Like, okay, I want to really focus my energy and effort in buying businesses.
So,
how did it all start?
Right. So we kind of always had the idea that that was what we were going to want to do, growth through acquisition. It was like a strategy that we wanted to use in the finance company.
Yeah.
So with like mortgage brokers will know it. If you're buying loan books, you normally get trail income. I don't know what the status is with trail income here in Australia, because in New Zealand they're starting to get rid of it. Probably the same here. I'm not too sure. But you can buy a business and effectively grow your business by the size of a business. So only do one thing instead of doing a whole lot of repetitive marketing and slowly waiting for growth to exponentially take place.
You
can just buy the company, and then you have the infrastructure to actually deal with the growth that you've just bought. Yeah. So that was always in the background. And I think one day we just decided, well, I personally decided that it was time to just turn that focus to other types of businesses, mainly because I think I could start to see the ceiling coming from where I was working. I owned a fifth of the business. My business partners were a little bit older, having kids, family, and I had all this gas left in the tank, and I still had relatively fresh legs. So I was like, well, I got to run a race for a little bit longer. And I thought, okay, well, maybe it's time that I do something else.
Nice.
So,
okay, and you choose to leave and sell your part and buy something else? What did you do after that?
So I sold my shares to my business partners, and then took about 6 to 9 months to then start finding the good stuff that I was going to be buying. Not so much dealing with like crappy little businesses.
Yeah,
it
6
took a
to
while.
9 months.
Yeah, it took about 6 to 9 months because we kind of, when you sell a you go through I went through a life change, right? Like you go from literally working in an environment like we just walked through to come in here with the boys, selling finance products and hanging out with people that you knew when you were younger, a team that you built. Had to go through this transition phase of then being by myself, setting new tasks that I had to do and really deal with that. And then we had COVID at the start of 2020. So that sort of threw all plans out the window.
Yeah.
And then kind of, no businesses were, like some businesses were thriving. I suppose if you were selling something like toilet paper because they, so we, that also put like put a roadblock in my way until one day I was on the phone with a really close friend of mine and I told him how I was just sort of hitting dead ends. Like I was finding these companies, I could do these deals that were pretty crappy.
Yeah.
Couldn't make them work. And then he told me about this guy. I'd always heard of him. His name's Graham Hart, and he used to be the richest New Zealander.
Yeah.
And he said, very simply, just why don't you check out what he did? So I pulled up Graham Hart's thesis. He wrote it when he was in his 30s in the 80s. Yeah. And it was about a group of event rental companies. So everything that you need for an event, he started buying them. And he did it in the 80s. And he wrote like a 70-something page thesis that he submitted for his master's at the University of Otago. And it was just very basic. And I was like, okay, well, if this guy did it almost 40 years ago, well, let's see if it still works. And no events were happening, but these companies were up for sale. So that's when I started to engage with them and started to buy event-based equipment rental companies. And it just made sense. Like the business model was simple. We take things from the warehouse out to where they're supposed to go, then we bring them back, and then we do the administration. So it didn't matter what the things were. There'd be some intricacies about the actual tasks we were doing. Yeah. But at the end of the day, we're just moving things from the warehouse to where they have to go, bring them back, and happy days.
And they pay, renting it.
Yeah, and so the whole theory of like buying businesses that do something similar allows you to sort of consolidate a lot of the costs that you otherwise would have. You can build infrastructure, so you could take companies that maybe were owned and run by a one-person or two-person team, and start to roll it into an existing setup that you've got, and you can grow very effectively by doing that. Yeah. So,
and the first acquisition went well, straight away.
Yeah, like I did some crappy ones. Like I bought a couple of businesses that were really just dead ducks. Like I couldn't resuscitate any of them. Like I went through the process of learning that the difference between a self-employed business and something with infrastructure. Yeah. And it was my first crack at doing something by myself as well. So there was a lot of extra admin that came with that. Yeah. Building infrastructure for a business by yourself is pretty difficult. And I just needed something with a bit more, with a bit more resources in it so that I could actually own the business instead of being owned by the business. Yeah.
Can you elaborate a little bit more on build infrastructure? Like, let's bring an example.
So infrastructure is stuff like, it could be anything. Like it could be just basic warehousing. That's it. Like an organized warehouse is a form of infrastructure for a business. Yeah. You know where things are. You know how they come out of the warehouse. You know where they're supposed to go back to in the warehouse. And some businesses are just not run like that. Yeah. They can be run very ineffectively, and sort of all the knowledge can be kept up in one or two people's heads. Yeah. So if they're not there, it's a very arduous process to figure things out, train new people. That's just one thing. The other part of infrastructure is also team members and employees, so that you can scale and that you can do more. Yeah. These things might seem very basic, but they stand in the way of people actually running a very effective business. And I think in this process, you start to learn how valuable your time is. Yeah. And so if you're the one doing everything, you learn very quickly that a good way to work 24 hours a day is to do every job in the business.
Yeah. Yeah, interesting. Okay. So going back, so you bought these rental company. Yeah. Went well. Did you have already everyone say like, you doing this, you are the manager, we
slowly built that. Yeah. So what we needed first was a delivery team to get everything out. We built that. Then when we bought the next business, we had an admin team member.
Yeah.
They started to help us out with the administration.
Yeah.
As we started to load more businesses into it, we needed someone to help out with the operations. We needed more customer service representatives. And then we slowly built, through acquisition, a big event rental company.
Right. Yeah. Okay. So you bought one rental event company.
Yeah.
And you bought another one, and the strength on this other one was admin.
Right. Yep,
you tell me if I'm kind of...
Yeah, you're nailing it.
The other one, the strength was the infrastructure.
Yep.
So you blend it all together and it become one thing.
Yes, slowly, over time, up until still going on. Yeah. We bought it. We rolled another event rental company in April last year as well. And so the whole process of doing that deal and getting it into like our system is now, that took about 2 weeks, where like one deal could at the beginning have taken a lot longer because we didn't have the infrastructure at the beginning.
No, because you have that. That's amazing. I love that. And naturally the value went to the roof very quickly.
Right. So the value in businesses is something that's like it's a really interesting concept, because the value, just, the same thing.
Yeah.
It's the market meets on paper, right? Like you can say that it's worth whatever.
That's right.
But someone's got to buy it and someone's got to let it go.
Yes.
So the value for me, the way that I've always seen it, especially in the small business space, is always going to be based on the cash flow. You can place value on equity, but you're kind of really banking on the fact that you're going to sell the business to someone else. You can do it, but the way that you do that effectively is by selling a great business. And part of having a great business is actually having a profitable business that doesn't rely on you as the owner.
Yeah.
That's the right recipe. And most businesses don't get to that point. So there's like a threshold that you want to get to know that you've got something that's actually sellable. And then that's what makes it really valuable in the eyes of a financial buyer.
Nice. I like that. And how do you evaluate a business? Like, do you get the financial statements? I know this can be a never-ending answer.
Totally. Yeah, look, my favorite way to evaluate a business is to look at the life that the owner of that business currently lives. So you can have...
Really?
Yeah, definitely. I mean, that's like an acid test. Obviously, I'm not saying you never look at the financials.
Yeah.
Right? But you do want to assess what kind of a life or what their lifestyle looks like. So I'm not talking about Lamborghinis, always sitting down at Bondi, drinking coffee, none of that. I'm thinking more along the lines of, are they healthy? Are they stressed? Do they take their children to school? Do they get to go on holidays? Are they in the pit with everyone else? What's their day-to-day actually look like? Because if you don't have that, you can have a great financially run business, but if you don't, you're effectively trading places with the owner. So do you want to trade places with the person that's not healthy, that's always stressed, with no plan to fix that? I mean, you can, if you've got a plan to fix it, then sure. But I normally start with that. Like, what are the obligations that I'm actually buying? And that's normally set by the lifestyle of the previous owner. And then I'm thinking about the financials. All that stuff can work itself out.
Yeah.
And it is important, but if you're buying...
The financial can work themselves out.
Yeah, it will. Like, you're going to buy something that's financially feasible.
Yeah.
That all comes after making sure that you know what you're getting yourself into and the obligations that you're taking.
Yeah. That's so interesting. And it's actually the first time. So you just look at the owner, look how stressed he is.
Yes.
Look how he manages time. Is it all set up correctly? If it's not.
There's that line in Suits, I think it's when Harvey Specter's going in to go play poker.
Yeah.
He says you never play the hand, you play the man.
Yeah.
Right? And so you just have to take a look at the other person, right?
Yeah.
And just say, all right, what's this life? Are they saying that they've got all the stress that's caused health issues? They don't see their children. They haven't been able to go overseas on a trip. And then that's just a good starting point.
Yeah.
And that has been something that I've learned from other people, where they look at the lifestyle that other people have. Hey, that person's got a nice car. What did he do to get that? Great. I'm going to go get that.
Yeah. I like that. I like the simplicity of it. So you bought, how do you call this strategy? Is it a roll-up strategy? That's
a
the
roll-up.
correct. Yeah.
That's a roll-up.
That's what you've done.
And like event rental companies, it's like, again, I'll refer to it as like a poor man's roll-up. We're relatively strategically.
Yeah.
But we're buying stuff that does the same thing in the event rental space. We're also in corporate food production and corporate catering. Well, commercial food production and corporate catering. So with that, we've managed to have license agreements where we can also make stuff for other people. And that's a way that we've added value to that part of the portfolio. So there's two different ways that you can actually play like a business acquisition game.
Yeah.
And what I suggest for anyone who is wanting to buy businesses is a great way to self-insure any future growth is to make sure that you're buying in an industry that is what people call fragmented. So if an industry is fragmented, it means that there are a lot of different businesses or some other businesses that compete with you or do similar things. And then that makes it easy for you to ensure that you can have some future growth because you can buy a competitor or you can buy another business that's similar.
Yeah.
So you can do things like a roll-up, which is a strategy where you're buying businesses at a lower valuation and through making the group bigger, it starts to become worth more. So you can buy businesses at what you might call a 2x multiple.
Yeah.
So let's say that the business makes $300,000 in owner's earnings and you buy it at 2x profit.
Yeah.
You're looking at $600 per acquisition that you do. Let's say that you buy, I don't know, like let's say that you get obsessive and you buy 5 of them. You buy 5 of them, 300 earnings, $600,000. $600,000 each. You've paid $3 million because you've bought 5. Let's say that the earnings is $1.5 million. You might sell that for 3 to 4 times earnings.
Yeah.
So every time you buy a business at 2 times, it automatically gets valued higher when you roll it into your group.
Got it.
So that's you call that multiple arbitrage, which is what you can get in a roll-up strategy.
Some juice there. Can you repeat that again? So you buy a business 2x multiple and you merge it into what you currently have.
Right.
Naturally becomes
worth more. And
3 times plus.
And you're paying a fair price along the way too. So it's not and the reason why, like again, this is infrastructure. Like if you're thinking about like what you're building, you're actually building a product. You're actually building a business product that someone else would want to buy one day. There are communities and people that will operate far above the level that you're currently at that want to buy businesses like that for a financial return.
Yeah.
So they rely on people actually buying these small businesses, doing all the like electrical work and like literally putting all of the businesses together, putting all the circuitry in, getting it ready for the bigger players or the people who are maybe a bit more financially well off, who are wanting to buy something just for a financial return. And they come in and take it off your hands. Now that sounds incredibly easy. I don't want to make it sound easy. This is a battle, and no results are guaranteed.
Yeah.
So,
and all of your 12 acquisition are within the similar industry?
Within those 12, I count the dead ones because they give me like a whole heap of lessons as well. The ones that couldn't really progress much further than just having always been like a solo operator kind of a thing. Yeah. But right now, event rental equipment and rental equipment companies, and then currently food production and commercial catering. So that's what we sit in at the moment, but we are looking to obviously buy good businesses still. Yeah. But we're not at the point where we want to swing off, and we just want to make good acquisitions from here.
Got it. What's the long-term picture? Do you buy a business because you want to hold it as an average for 4-5 years and sell it to a certain amount, or what's the picture?
Well, for everyone, I'd say, like I was saying earlier, you can't be guaranteed that you're going to sell.
Yeah.
You should never think for a second that there is going to be a buyer.
Yeah.
So that means that every buying decision that you make is based predominantly off of the cash flow of the business. That's the strength to buying businesses. Like I'm sure people who who have like your clients who have worked with you or your listeners, they'll know that they'll have looked at businesses, for example, and said, "Are you telling me I can buy $1 million place out here or a $2.5 million place in Sydenham?" I've looked at these prices, insane. You're gonna buy a $2.5 million place there. You're gonna get $75,000 in rent. I don't know. Yeah. But if you spend $2.5 million in a business, you're getting a lot of money back most of the time. Like the yield's way better. So you got to really focus on the cash flow game, unless if you have a core strategy where you're going to prepare to sell it.
Yeah.
the original plan was to buy and hold them, but through the growth that we've had through some of our brands, it's starting to make sense that if we continue to grow them organically, we can look at a buyer for some of it. So starting with cash flow, and then if you are going to go on a buy and build strategy, then you want to, from the day that you buy, you really have to already start looking for more targets and then the end buyer who's going to buy your group that you've put together.
So you need to have a strategy in place. You don't just go there, buy a business. Oh, I'm cool. I've got a business.
Yeah, nah, not at all. It's got to be purposeful. So like I'll give you an example which might be really good for some of your clients in your agency. They might get stuck with their purchasing,
Property
right?
acquisition,
Like
yeah.
that happens.
Oh, yeah.
And I've worked that. I've tried to rework.
capped.
They get capped, and it's all from servicing. It's almost never from equity because equity, it can be from equity.
That way you
right?
can
But-
play around with entity and stuff, but
Right.
still, yeah, you get capped.
Right. So at some point, you're going to have to make purchases that lean towards assisting your servicing,
Yeah.
not detrimenting it. And it's kind of like you got to pick one. You want to balance a portfolio, and you look at capital gains. And you're like, yeah, it'd be nice to own this house at 2, and then in 10 years it'd be worth 4. That's awesome.
Yeah,
But then when it's 4, how are you going to buy again, rather than divesting and selling? So I know that there's all sorts of strategies that people will have for managing a property portfolio. But if you're loading up and you want to buy more real estate assets, you could find one business that's just going to need your administrative efforts. That might not really need the same sort of level that you need to give in employment.
yeah,
Might help you earn more money than what you can in employment, perhaps, and afford you the lifestyle, and also help you continue to push your servicing so you can load up with more property. So in that instance, you might just want one business that you know is gonna go for another 10, 20 years. That's just gonna help you juice your property engine.
it looked good in front of the bank.
Right.
How do you pay yourself from the business? Do you pay yourself a salary? Do you how do you break it down?
Yeah, I mean, at the beginning, I was able to live pretty frugally. I was, single, no kids, didn't really need like a massive place, and didn't really have any major personal debts to settle. I squared up with all the gangs and mafia early when I was younger.
Yeah.
But no, so yeah, it only over the last like 2 years did it then transition from taking chunks out whenever I just did need it to then being able to pay myself regularly to then have my own personal investment strategy outside of businesses as well. The reason why that happened like that for me was because I was just going all in on business acquisition.
Yeah.
I could have taken more money out, but I saw the positive effects of the snowball.
Yeah.
And I just knew I had to keep adding to the momentum.
Yeah.
You don't have to do it that way because you don't have to go out and do 12 deals.
Yeah.
But if you do 1 or 2 good ones, you should be able to start paying yourself from day 1.
Yeah. Nice. How important is structuring when you buy a business? Like, personal name.
Yeah, I mean, everyone's going to have their own personal financial position.
Yeah.
We can even add into that if you're single and you got to think about prenups and all that sort of stuff that comes into it. You also might have different shareholders or directors that you're dealing with. So you'll have shareholders agreements, and you have to do proper company formation, and you'll have to do proper administration of the business too.
Yeah.
So structure is going to be real important. Obviously, you're going to buy it in a company. What kind of an entity holds it? Is it going to be a trust? Is it your personal name? Is it a holding company? Who knows? So we run it through a holding company. So we've got a holding company that's based in New Zealand, one now that's based in Australia.
Like a fund?
Well, it's actually just a limited liability company.
Ltd, yeah.
Yeah, and then here we have the PLTs as
Yeah.
well. So that's what our Australian one is. So we own everything in our New Zealand-based holding company.
Yeah.
For New Zealand,
Yeah.
Australian holding company is owned by our New Zealand holding company.
Yeah.
And then whenever we add another asset into it, we'll either make a new company, or if we're buying a business that fits within a certain group we've already got,
Yeah.
we just throw the thing in that one.
No.
Yeah.
Let's throw the thing
Just throw it in.
No,
But
it's
everyone-
not, that makes sense.
Yeah, but before the journey, like it's I think people shouldn't be too, like with real estate, people shouldn't be too intimidated about these conversations with professionals because they are really basic to understand.
Yeah.
It's just new. That's the
Yeah.
only thing.
No, it's true. And Yeah, me actually following your course, I've done the first 3 lessons, is already slowly start to make sense.
Right.
Now, yeah, I'm in an industry where maybe there are certain similarity, but yeah, I would say property is more of an asset class used for growth.
Yeah.
I think business, based on the conversation, is more of a cash flow
Yeah.
asset class. Now, I'm giving this is not advice. I'm giving just my opinion for my basic understanding for now.
We meant to say that on
No, that's not financial advice for sure. But
yeah.
okay. Now you are pretty advanced. So let's say someone new.
Cool.
Like the idea, has no idea. So what would you say the price range they should target? Like, all right, you should target anything under 5 million, as an example.
Yeah, cool. Well, there's a sweet spot. The sweet spot has a lower limit, and it does obviously have a higher limit as well. And the lower limit can be based on a few different things. Like for myself, with the strategy in buying event rental companies, because I knew a lot were coming on the market and I could identify them.
Yeah.
I was happier buying smaller businesses because I knew I could patchwork them together to build something bigger.
Yeah.
So that's a great reason to buy something smaller. Probably the only reason that you should be buying smaller stuff. Because with that, you don't have the firepower to then be able to deal with things like adding debt, paying yourself from day one, and then also dealing with market fluctuations. Because rent, for example, comes in every day on a Tuesday or every week on a Tuesday or every fortnight on a Tuesday, whenever it comes into your account from your property manager or from your tenants. But with business, borders close, people get sick, the economy changes, all sorts of things like that can happen. So you want to have more than what you need. And also you want to be buying at a level that beats whatever income you can get, for free.
Right.
For example, maybe I can go out and get a job that'll pay me $200,000, $300,000.
Yeah.
If I'm buying something I'd have to be buying something very compelling, because I could just go and, I'm not saying I can go and walk in anywhere and just get that job.
Yeah.
But if you're a person who's capable of earning a certain amount, just remember, jobs, you can go get them.
Yeah.
And you don't pay much for them. So you want to earn something that's going to be able to give you a earning capacity far greater than what you can get from employment.
Yeah. Right.
Because why else would you do it?
Yeah. If not, what's the point?
Yeah. I mean, you can hate your boss.
Yeah.
Don't get me wrong.
Yeah.
Because now I'm that guy, and but at the end of the day, like you want to make it worth it for yourself. So to answer your question, perhaps you want to aim for maybe 100 grand over what it is that you're currently earning. And then naturally that's going to set what it's going to be worth the business.
Okay.
And then when you start hitting like $1 million earnings plus, the valuations start to get pretty hefty. So you're then in competition with trade buyers, other financial buyers, more astute acquirers as well.
Yeah.
So we're punching it around that range is what we're aiming for in our next deal.
Yeah.
So but we have like a asset base that we're working off of, which allows us to buy at that level. So first time, anything underneath that, you're going to want to maybe 100 grand more than what you can earn in a current job.
Got it.
And then all the way up to where the bigger players start coming in.
So let's use an example. Someone is an accountant right now, make 200 grand a year. Cool. You want to buy something that pays you around 300.
Great starting place. Yeah. If you buy around 300 and it's in a fragmented industry and you can buy one more, that's giving you 300 at earnings.
Yeah.
You might be able to find 500,000 or 600,000 extra in income over a 4 to 6 year period.
That's appealing. Okay. And thank you for that. What would you say is the minimum capital someone should realistically have to buy the first business?
Well, you want to try use as little as of your own money as possible, right? I think like your money really, the way that I treated my exit from the finance company, I actually never touched that.
You never touched
it? Yeah, never used it to buy a company. Never used it. So I always tried aiming for vendor finance or raising capital, so private investment, either in debt or in equity. Yeah. And then that way, any money that I had was always going to be the fire extinguisher if things got really bad.
Probably they give you an offset account. Is that the same thing in business? No, not really. I'm just...
Yeah, you can get lending. People borrow against businesses.
Yeah.
Right? But the bigger the business, interestingly, the easier it is to borrow.
Yeah.
The easier it is to also raise money for investment if the business is bigger as well.
That's an important one. Can you repeat that, please?
So the bigger the business, the easier it is to be able to raise money for it, either through the banks, through private investors, and that's through equity or debt.
Because he's established, has all the
resources, the infrastructure's in place. It can deal with swings. It's got it should have. That's not the only thing you want to look at. That's a green flag. So with that, you've got more to work with.
Yeah. The next question is, what would you say is the most common mistakes that beginners make? Like, because often what I notice, I'm telling you my industry, you tell me if you got any similarity. They often, they go in, want to buy a property, they're very emotional about it without actually having reasons behind it, having a long-term picture.
Okay.
Based on your experience, I believe you train people, you coach people, you consult other companies. What is the common pattern that you see in naive, and I am a naive, down the line, I want to buy businesses, that commonly naive business buyers make?
Right. First one, too small. Starting too small with no plan for it to become bigger. That's a common one. There are a few people, like off my Instagram, I get a lot of DMs. People just send me, hey, I've just checked this one out. Give me your thoughts. Most often, too small.
Yeah.
That's unless you've got some really compelling growth strategy, no point. And we've already discussed that. But other than that, the emotion thing is huge. The emotion thing is a big deal. People can get very emotional and also getting wrapped up in the first deal. It's just like dating. You can't go for the first that comes across you, right? Like you wanna make sure that you're taking your time to assess the market.
Yeah.
Because if you think about the snapshot that you get served right then and there, you're only looking at businesses that are available for sale at that point in time.
Yeah.
If you stretch it out to saying, hey, this buying journey that I'm on is actually a 2-year process, you actually end up self-educating yourself on what you like about businesses. You start to understand similarities. Your brain starts to shift differently. You end up seeing industries that you like so much that you actually find the guts to pick up the phone and cold call owners and be like, hey, is your business for sale? Because you can develop so much conviction along this process as to what you actually want that you end up driving yourself in the right direction to go and get it.
I like when you mention, you need to jump on the phone and call business owners. Yeah. Okay, so let's break down. So someone right now listening, like, I've been thinking about doing this. What's the first step they should? Maybe they've been watching your stuff. Okay. They get a little bit more knowledge, and they want to get the practice, the reps in.
Cool, easy. Right? So you just go on any business broker's website. That's just a good place to start. The reason why I'm not saying that you should. And I'm not saying that you shouldn't buy stuff that's listed with a broker. Yeah. But it's a great way for you to get prepared financial information. Oh, and also they can be prepared and not prepared. Like I've seen horrifically underprepared businesses that have come up through brokers. But what you want to do is you want to start going through the process of reading information memorandums, understanding what the financials look like, what they should look like, asking questions, and just gaining confidence in a really low risk environment where the transaction's ready and the seller has indicated that they want to sell. Because in that process, you end up learning so much about everything. You end up understanding how a particular industry works. When you look at a separate industry, you'll understand how it's different. That's how you get the reps in, is just through going and seeing what's listed online. You don't necessarily have to find something online, but this is where you start figuring it out, what it looks like. You think about sports, for example. If you play a new sport, you're going to go do training first. You're going to figure you have preseason. You're going to play with the team, get to know who everyone is, practice set pieces, your plays, get fit. Yeah. And then all of a sudden the season starts. You should treat it kind of similarly. You shouldn't go and just think, oh yeah, we're going to sign up. I've never played this sport. We'll just go play a game and see what happens. It's a great way to tear an ACL.
That's right.
Yeah.
Nice. Okay, so ideally you go to the business broker websites because I already have the paperwork ready.
Yeah, and then start looking.
Yeah.
And absorb it. Just get used to it.
And get the reps in.
The reps.
What would you say are the business that you personally stay away from?
consumer, like box store retail style stuff. The reason why is because demand, you can miss demand. So let's say, for example, that you go and you overlap. Great example for like retail could be someone who went out and bought a whole lot of COVID masks.
Yeah.
Right? Like I'm sure that there's businesses right now
Yeah.
that are sitting on a lot of them. It's like how retail demand can shift.
Yeah.
So in the throes of like buying products and deciding how you spend your money, you can miss purchase. And so that ends up, it's dead stock that sits there that you can't sell, that you sell at a loss. And you're kind of playing this like mini trading game. Like you're trying to trade stuff. Like you should just trade stocks and trade like currencies and whatever if you're going to do something like that.
Yeah.
So I try to stay away from stuff like that. The commercial food production and catering company that we have has elements of hospitality, but I'd never do anything that's like sit down, eat, dine in because of things like discretionary spend.
Yeah.
That's something that gets shot really quickly if the economy goes down. And then also food wastage. So that's an element, same with nightclubs and all that. So really it's based off of those things. And then again, I sort of have my buying rules set at minimum earnings. So like a minimum earnings would really have to sit closer to 500,000 for me to even want to look at it. 500,000 upwards. And then customer concentration and concentration risks in general is another thing that you really want to stay away from. So a concentration risk will be something like, let's say looked at one the other day with a guy I know. He was looking at a panel beater and they did about 60-something% of their work through one insurance company as their referral.
Yeah.
So if that insurance company stops referring business, 60,
gone.
Exactly. But you can have concentration like that everywhere in a business. It could be through key team members. It could be through specific products that you offer. Somewhere in the business, there can be a weakness where if that one thing stops, you stop getting sales. And that just cuts off all life support to the business.
Yeah.
So staying away from stuff that has any kind of concentration risk.
Okay, concentrate. So you mean if a business relying on one or two customers to be alive, and one of them, 50% is gone.
Right. So
that's kind of the basic.
Yeah, right. So like the way that concentration risk is currently assessed by most people is through customer concentration. What I'm saying is like there's a mecca above that where concentration can be, hey, we're buying this cafe because it's in a really good location.
Yeah.
Well, if something happens to the location or the lease doesn't get renewed or the buildings, then what are you going to do? So, and then it's also one particular customer type as well. So if you only service one particular, let's say you service office workers in a CBD environment. Well, if people stop working in a CBD, which has actually happened when we went into the whole work from home thing, you actually have a huge drop in revenue based on your location or your customer type. So you can start off with learning what customer concentration risk is and then take that one step further and say, well, where are all the weak points if this one thing was to stop happening? Where are we running into trouble?
Do you have like metrics that you follow where there is a line between, all right, if the concentration rate, just lining up, so is this, walk away. I'll give you an example. The way we select investments is the average annual growth has to be between 8 to 12% per year for the last 10 years. That's the definition for a blue chip location. Okay?
Sweet.
So like this is give us some indicators for investment. Owner occupier, different, more emotional. Do you have any specific metrics now? You don't need to go through all of them, one or two.
I think one way to just get a real good test on it is to just actually model the business as if that worst case scenario actually happened.
Yeah.
So just let's say that you've got a customer that gives 20% of the revenue to the business.
Yeah.
Bin that customer and just say, okay, let's run the same financial reports of the last 2 years without that customer in the business.
Interesting.
Because if you did that, then you'd say, all right, well, the business is 2 million in revenue. We've just lost 400,000 in revenue. Here's how much it costs to do the work for that customer. Here's the profit. And then just slot that into the report and just say, well, this is what the business looks like.
Nice.
It's not, you don't have to kill, that doesn't have to be a deal killer. You can say, all right, well, it's highly unlikely that that's going to happen, but we're not going to take, We're not going to give you all the money for the business up front.
Because of,
Like, well, what if that happens? So we really want that customer to stay in for 2 years.
Yeah.
If they don't, then that means you might not get this earn out, might mean that we reduce how much we have left owing to you on the settlement of the deal.
yeah.
So it doesn't necessarily need to kill it. You just need to be prepared that things like that do happen in business. And there is a silver lining, right? Like I looked at coffee roasteries a long time ago. There was like 3 or 4 on the market back in New Zealand. I looked at them, and some of them serviced a couple of really big establishments that were going through a lot of coffee. So they could lose one and lose a lot of revenue, but they could also add maybe 1 or 2 and get a lot of revenue too. So it can go either way.
Yeah.
Because you can still add good clients. You just want to mitigate risk. So in terms of like a metric, I'd say I'd just look at the worst case scenario and say, okay, let's pretend like that actually happened. What does the deal look like now? How do I protect myself from that going into the transaction? Because I don't want to pay for something that doesn't happen. And you can still work a deal like that because the owner probably knows that concentration actually exists in the first place.
Yeah.
So it's about communicating risk reasonably and trying to put together the right deal for the business.
Man, I like all of these sounds. Concentration risk, multiple arbitrage. That sounds sexy to read. You just need to understand it.
Yeah.
But no, I'm following actually. Thank you. A lot of people explain and mention about buying business, no money down or little money down. Can you please elaborate? How do you fund the business and how a vendor can be paid in selling a business?
Yeah, right. So yeah, totally. The whole no money down thing / vendor finance or seller financing thing is kind of like it's a real catchphrase, isn't it?
It's
a
marketing?
real let's go get some attention. That's how I feel about it because I've done deals like that.
Yeah.
In fact, buying the finance company, it was on a vendor finance deal. So from owning that part of the business, I then made more money, which meant that I could then pay slowly the debt that I had for that business, or the shares that I bought. Now, that deal, it didn't happen overnight. Like, I was a good performer in the business. I built a strong relationship with the team. I was a core part of the team as well. And then that ended up happening. So those deals do happen. There's so many footnotes and asterisks as to what needs to happen for that to be able to be reasonable. If you're Joe Blogs and you just walk on the street and you go and say, hey, your business is for sale, here's $1, I'll pay you the rest over 24 months with the profits from the business.
Yeah.
The guy doesn't know you, there's no test of your capability, there's no trust built. It can be like you can see how that doesn't sound appealing to a seller. Now, there are scenarios where that would be, but I think it turns into more of like a opportunistic kind of a strategy rather than trying to find something of real value that you can raise money for, either through a bank, through private, through investments, whatever, to actually buy a good business. So you certainly can do deals like that. They don't happen very often. But again, they're very, very opportunistic. So the way that you do it is you can buy these businesses and you can structure a debt or a loan to the owner and that you can pay it out of the profits of the business. Not many owners are going to take that, but owners are open to taking deferred settlement. So it might not be the whole thing, but it can be a portion of it. So if you can't quite front up all of the money for a deal, perhaps you've got an investor that might be bringing money to the table, and then maybe the owner's willing to take the rest of it deferred over a 1, 2, 3, 4, 5 year period. That could be a deal that you could work out.
Yeah.
So not looking at vendor finance just for I'm going to give you nothing, you give me the keys, and then I pay you later if the thing works. It's a very entitled approach. Very
doesn't happen
opportunistic.
that often.
It does. It can happen, right? And it does happen. But I think that there's a lot of pre-work that you can't go from one day never knowing about buying a business, no money down, and then just the next day going in and being like, this is now my life, and I do it left, right, and center.
Yeah.
But you can go through the process of not using any of your capital.
Yeah.
And so raising money through through getting a good deal, getting bank debt, structuring it well, you can do a none of your money down in the deal. So that's possible.
Nice. Okay. So it's possible, but don't get into the industry just for that.
That's literally the mistake that I made with like the first couple of deals after the finance company. I was just determined to try and do a no money down deal to satisfy this. And the first few deals that I did in the event rental equipment business or in the industry were like to a degree like that. But eventually, after snowballing everything, we're paying for acquisitions out of the profits of the business. So it's still technically no money down.
Yeah.
It's just snowballed from cash coming from the companies, not myself personally.
Yeah. Nice. Okay. So don't get into buying business just for the reason of no money down.
Yeah.
Thank you. Next question. Should someone start buying businesses that they understand and know, or does it really matter?
I'd say that if you're going to buy a business, you want to understand what you own.
Yeah.
Do you need to know how to do absolutely everything in the business? No. I'm sure that some of the people who work like in the food-based business that we own, if they saw what I cook for myself at dinner, they're not going to be very impressed. So I'm not going to be going and like helping out a whole lot anytime soon. So again, that's a product of being able to have somewhat of a blind side in that area, because you know that you can hire people to do that job and you've got a process to do that and a team that can backfill right now if they needed extra hands, right? So if you buy big enough, then your skills and your shortcomings are actually much less important. But in saying that, if you're buying smaller, and if you're buying businesses anyway, you want to understand the mechanism that that business operates under. Because that's when you understand the business, you're going to be able to build financial projections that make sense because you understand how that business operates. You don't want to be green-eyed and sort of, that's kind of like driving blind. So you don't want to be, if you don't have an understanding for a business and you start modeling things financially with no understanding of the rhythm of the business, how it's paid, how to cost things effectively, how staffing decisions alter the profitability of the business, everything. Like if you don't get that and you just randomly set targets, you're going to get results that you have no idea what you're doing to actually get them in the first instance. And so if you don't know what that is, you can't actually repeat it. And you want something that you can continue to repeat because you want your best chance of continually to get the cash flow that you originally purchased.
You want.
Yeah.
Yeah. What's the thing that people mention about buying boring businesses? You hear like Cody Sanchez online, so give us a bit of a practical practitioner.
Like what a boring business would be.
They mention rubbish, like, laundromat, or, the one that been, because makes sense the way she explained.
Yeah.
Now, of course, there is a marketing in there. That's why I want to ask a practitioner like you.
Cool.
So do you target specific industry that they have the proven track record, they work?
Yes. Yeah. Every time. That's what I like. Yeah. So definitely not so much like on the startup, new idea kind of a thing. I've got these guys back home and the one came up with this really good like dessert brand that he's been selling at markets at the moment.
Yeah.
And so I said to him, and he's been trying to raise money to actually buy the stuff that he needs to be able to then set up a kitchen and then be able to produce it at scale. And I said to him, why don't you just buy a bakery? Because then you've got everything that you need. Everything's put together. You take over the lease. You've got people coming in buying already. So you've got revenue. Yeah. You just need to use the stuff to be able to continue to produce what you need for your markets and also to scale. So that's like a far easier way for him to actually enter into growing an idea that he's got. And I'd recommend that over just starting something. But to the point of like specifically buying businesses that are boring, you're looking at things that have been established for at least 10, 20, 30, 40, 50 years where there isn't a lot of change to that industry.
So 10 years plus established.
Yeah, like the industry. Like if the business has been 10 years old, if the business is 10 years old, then that's awesome. If it's if that industry is 10 years old, for example, like a 10-year-old industry right now could be like, well, some parts of digital marketing, right? Like so
Right.
some elements of digital marketing, some parts or some companies could be that industry could be 10, 15 years old. If you think about like search traffic on Google
Yeah.
or
Wow, I think 10 years already.
yeah, so if you go, well, maybe longer. Like I'm not personally deep in the industry,
Yeah.
but that's something that came around because of advancement in technology, and then the industry was built. But that's always going to be changing. So if you think of software and tech, then you have the rise of these small software companies. Now anyone can go out and vibe code software.
Yeah.
So why were we making these software
Yeah,
companies for
yeah.
the last 20, 30 years? So I think you want to look at stuff where the functions are just so basic. Like you take rubbish, for example, take skip bins, right? What do? Guy calls you up, doing a reno. All right, I need a skip bin. Great. You drive the skip bin over. It's there. They fill it up. You take it to the trash. Done. Pretty boring, but it gets the job done. Trash is always going to need to be moved on site to whatever waste management plant it's got to go to. So that's good. It's probably always been like that, maybe with micro developments, but those developments don't happen often enough for you to need to then completely rehaul your entire pricing and business model and all your staffing. So that's what I think that's what she really means by boring. It's kind of like not finance. It's not something very sexy. It's not software. It's not things that change quickly. It's not something that's trendy. You want something that's just solid, gonna do the job.
Establish it. Okay.
Yeah.
Nice. How can someone get into that tunnel of buying a job instead of buying a business?
Right. So the whole buying something that
what's the thing they should look at, and what's the hire they should keep an eye on? Because few people will quit when you buy a business. Is that right?
Yeah. Well, if you're buying like a going concern, like let's say if you buy a business, you're not normally buying the shares. Sometimes you will.
Yeah.
But you're not normally buying the shares of the other person's company. The reason why you wouldn't do that is because that director or whoever's been directing that company has operated it for however long, which means that entity has had tax obligations that it should have filed and should have fulfilled perfectly. And if it hasn't, and you buy the shares and then you're the director, you are potentially picking up the responsibility of reporting that you didn't do, but the company might have done incorrectly years previously. So the reason why that's relevant is because if you set up a new company, normally you end up taking on all of the employees of the old company. So you got to hand them back their employment agreements.
Right.
Say, cool, can you sign this? So you imagine new owner comes in buying the business. You're normally going to get a few people saying, oh, I haven't had a pay rise in 18 months and it was promised to me.
Yeah.
I'm not
There
really
you go.
feeling like it. So you have to be prepared for that.
Yeah.
I've had friends who have bought companies where people have just used that as the opportunity to say, cool, yeah, I'm leaving. So you're going to get some of that.
Yeah.
And you might. And I think that in the lead up to the business being sold, if it's being kept a secret, that's probably a bad sign, because then the management don't know, then key staff members don't know. One day, the owner's going to walk in and say, oh, by the way, sold the business. This is my last day. Here's a new owner. Goodbye.
Yeah, that's a sign.
And they relinquish all of their responsibility and carry of any of the risk. I've got a mentor, and he says often that buying a business full cash up front is like giving the star employee a bag full of cash and letting them ride off into the sunset, and you get left with all of the obligation.
Yeah.
So you want to be careful of that. So the way that it's sold, the way that staff members are retained, that the key staff members are filled in on the change that's about to happen, all of that's very important. So if it's kind of shady, people being very secretive, don't want staff to know, it's like, why? Why don't you think they're not going to stay?
Yeah. That's a red flag right there.
That's a big red flag. So
interesting. So yeah, okay. Ever happened to you before?
No, thankfully not, but it has happened to friends of mine.
And that's leading me to the question, the due diligence part. Like,
Yeah, right.
I mean, I believe there is a lot of things when you merge a company or buying a company.
Yeah.
Give us a couple of things when you do some due diligence. I mean, you explained one kind of already.
Yeah.
Give me another one.
Well, let's go into financial due diligence, because I think this is something that people normally look at financial due diligence and would say, I don't know what I don't know, so I'm going to get an accountant to look at it, which is a great idea.
Yeah.
So if you get an accountant to look at a business, what they might prepare is something like a quality of earnings report. So what a quality of earnings report is it looks at the money that comes into the business, looks at how it's sourced, looks at how it's being coded and how it's being put together in the financials and the bank accounts to make sure that the money that's come in matches, that we know that we're looking at the right reported information.
Yeah.
They can make comments on that to just see how accurate everything is. And it's not limited to that, but imagine that's really probably like the main crux of like a quality of earnings report. It's a lot of work for someone to do, but the key here is that what they're doing is actually getting the bank statements of the business to see what is actually happening in the business over the reporting period. Because that effectively, I mean, you've looked at your business bank account, you know what it's like. It's a dashboard. It's like you're flying a plane. That's your main thing that you're looking at, because that's where you're making moves from. Do we have money for this? When's this coming in? Okay, here's the rhythm. I know every year I've got to be prepared for these bills, taxes coming out here. That gives you an understanding of what your cash flow should look like. So when you do that and you look at the bank accounts, it's like the level above just looking at the financial reports. Is to actually look at evidence and see that the money that is being said is coming into the business is appearing on the profit and loss. Because that's the data that should be giving you all the basis for what you're valuing the business at and why you're buying it in the first instance. So you can find some really interesting stuff in there. I had a guy a couple of years ago, actually, we were looking at a company and he brought it to me and we were looking at it together. I said to him, well, what's really funny is that I can't see any tax payments coming out of this business. So obviously buying the company, he's not going to have any responsibility over the fact that that company isn't paying tax, because he's going to have a new entity. So he's going to have his new relationship with the ATO or the IRD, whatever country you're in. But it showed the weakness in cash flow. And so it made me realize at that point, like you really have to track and make sure that you know that every payment that should be coming out as if that business is being operated is. Can you see regular money going out from the accounts to an owner? Because if you can't, then how's the owner getting paid from the business in the first place?
Yeah.
So you kind of want to look at it and say, all right, well, how's this thing operating from a cash flow perspective? Do I like it? If I put debt in it, how does that work? If you have a seasonal business and you have dips in winter, for example, but you've got solid debt repayments, if your profits drop in winter and you're not prepared for it, your debt payments stay the same, but then your profitability dips. So how are you going to pay your debt? All of these things are part of like the wide investigation as to how does this thing operate today when the owner goes and if I step in and all these new obligations that we put into the business, what can we expect the new baseline to look at and are we prepared for it? Yeah.
So you say you, as an average now, you buy 1 or 2 a year. Is that right?
Yeah, we're probably going to be doing, last year we did 2. We did a big one and a smaller one. And then this year, I'm pretty sure we're not going to buy. We're just growing organically. So one of our companies we're growing through Australia, set up in Auckland. It's now in Brisbane. There's a satellite site in Gold Coast. We've done Melbourne. We're now in Sydney. We'll hit Perth and Adelaide. So we're going through that. So it's a sort of like a real big win that we're able to grow with a little bit, with not a whole lot of capital investment. Probably 27 into 27, I think we'll be looking to do another transaction. So yeah, we're aiming for like one good company on average every year.
Every year. Nice. How do you spend your day right now?
Right now?
Currently.
So it's really cool. I've got, so the holding company is owned by myself and 2 others. So I've got 2 minority shareholders who have bought into the business. One is one of my best mates. I've known him since we were 13. So he started working in the portfolio and was the owner of it start of last year. So it's been a lot of fun working with someone you really like, trust and respect.
That's good.
So we're like working side by side pretty much on doing all the infrastructure stuff for Sydney. But then there's a whole lot of trips booked in. One of the food and the catering companies based in Wellington. So last night I flew back in from Wellington. A few trips to Auckland for those companies. We'll be prospecting, making content, writing. That's what I do a lot of, and then just training. I'd be a run or a workout, and then just the way I see it now is kind of where players that come off the bench, we have to stay fresh because sometimes it'll get busy. There'll be key tasks that we have to do. We're not really hammering everything every day. So it's like a load management process for us.
And you need to get good in hiring the right people as well, especially.
Yeah, definitely.
Like, do you look at a specific quality, a specific personality? Like, this job need this type of guy or girl. Or you go on gut feeling? Or do you got an HR who's doing all of that for you?
Yeah, I think eventually we are going to need some form of HR to do it. We haven't got a firm plan for that at the moment, but we have our staff members actually doing the hiring.
Yeah.
The staff are the ones who are working with these hires the most. So it makes sense that they're the ones that should be picking the people.
Yeah.
That doesn't always work out to plan.
Yeah.
But obviously the team's doing their best. So we're like, that's something that we're working through at the moment where we're stepping back from being the ones who are hiring people.
Yeah.
Obviously key hires we need to be involved with. But yeah, I think with hiring the right people, you really rely on they want to be there. That they've got some kind of initiative and curiosity, and then everything else can come afterwards. People can become more skilled, but you really need the attitude, and you really need them to actually want to be doing what they're doing.
So true.
Yeah.
Like even with us, like we're always looking for expand, and looking for the right people, and based on experience, it's like. The fresh new start has got just the student mentality, work ethic, and want to be there. I can train them up to that level. Do you know what I mean? And the people that have been in the industry for long, that you expect to have a lot of experience, in my eyes, to do things that don't make sense.
Yeah.
So sometimes I find it harder to retrain someone with experience than train someone fresh and want it.
Right. Yeah, they kind of have an appetite. The right person or like a high performer almost really has an appetite for like discomfort or challenging themselves. And it shows up in really different ways. I've got a friend who's like started a fund, like a mortgage fund back in New Zealand. And he, like 3 or 4 weeks ago, he just sent me a photo. He did a 100-mile race. And so most people would be like, yeah, that's psychopathic. And like, yeah, he'd done 3 more like 100-kilometer races before that one.
Yeah.
So
the boss is one of them. He does.
Yeah. So they kind of, those sorts of people, there are these behaviors or things around people's lives that based on what sort of a role you're hiring, you can see like if you need someone very organized and meticulous, then there are clues around what that person, their life and what they've built kind of looks like that. Yeah. So yeah, there's a way to sense check that in the hiring process.
Mate, has been more than 1 hour. This has been, I got so much stuff. Thank you. You've read a book.
Yeah, I've written like 80% of it. It's called Speed Running Capitalism.
Speed Running Capital. Just the sounds great to me.
Thanks.
Is that correct to say, I don't know, I'm just thinking, is using businesses to actually build your...
Yeah, to grow your wealth. So what's happened right now is we're in the age, it's already been happening for a while. People have always bought businesses, but now we're going through this process of all of the assets coming up for market and people are now buying them. And so this asset class has never been able to be transacted on as heavily as what we're going to be seeing over the next 5 to 15, I don't know how many more years, 5 to 15 years. So it's revealing this new asset class that kind of needs to find a way to fit inside of people's wealth building tools.
Yeah.
We can go on and on about how you can use it to help your serviceability with real estate and holding more property or to buy more property faster. But it's kind of, it's an opportunity to turbocharge your wealth building strategy if done right. And that's what this book sort of covers. There's like a philosophical element to it, to help you get bearings on how it is that sits into the reality that we're going to be living in, or that we are living in already. And then very basic on how to do that, and like how to actually, what to look for and how to go through the process of buying a company. So it's really, the heavy lifting is in like the philosophical part of it, which I really enjoy. And then the basic stuff is just actually doing the deal.
Nice.
And then you got to keep it and run the company and all that. So it's been really fun writing it. And it's given me like a lot more confidence when going to scenarios like this to actually talk about this as a way for people to build their wealth, because I've had to like hash out all of the beliefs. I'm really excited to launch it or to release it.
When do you expect it's going to be ready?
Oh, look, I'm hoping by the end of April.
By the end of April.
Yeah, I'm hoping by the end of April I can get it out.
People want to contact you. What's your Instagram, LinkedIn?
Yeah, just go Instagram. It's Brendan Lippman _ and then the email's real simple. It's brandon@brandonlippman.com. And I got a website. You won't miss it if you go looking for it. And yeah, easy.
You got a free course as well that
get in there.
I'm watching, and has been I like the way you break it down. Cool. Very understandable.
Yeah, and I write a newsletter once a week. I put it out. I just take one deal that I think looks good. I send it out. I show people why I like it. And then there's just other stuff in there, tidbits about acquisition or whatever. So there's plenty of stuff for people to enjoy.
Mate, thank you so much for doing this. Thanks for coming in.
Yeah, thanks for having me. Awesome, mate.
This is general advice and does not take into account your objectives, situations, or needs. You should consider if this advice is suitable to you and your personal circumstances. Please read any applicable PDS beforehand.